How's it going? This is Nick Fenton here, in-house options expert for Likefolio, and today we're going to be discussing covered calls. But before we do that, got to make sure you have social sentiment on your graph. So let's go to Style, let's go to Settings, make sure in the Equities tab, and make sure Show Social Sentiment is checked, then hit Apply, OK. We also want to add Studies, Add Study, Volatility Studies, and then we're going to go up to Imp Volatility, which is implied volatility. We want to factor this into the equation in this particular video as well. So social sentiment's only available in Thinkorswim. If you're not a TD Ameritrade customer, you won't be able to access Thinkorswim, and you won't be able to access social sentiment. So with that being said, definitely go over there, sign up, create an account. At the end of the video, we're going to tell you about a special offer we have for creating a TD Ameritrade account, so stay tuned. For now, covered calls, interesting strategy. Definitely Disney is a good opportunity for a covered call, and here's why. First of all, if we look at implied volatility, it tells us that there's some decent premium in Disney's options based on the implied volatility graph here. Let's pull up the oval tool. The absolute high in implied volatility in Disney is 40. Absolute low is about 10%. Currently, we're at 25%. If we look at the areas where we've seen more consistent highs, I'd probably say right around this 35 level would be a little more consistent. We saw several touches at that level. And then consistent lows, I would say more so around this 14 or so level. So what you can see here, we're pretty much right in the middle. So that gives us, that tells us that the implied volatility is pretty much right at the mean. When you're at the mean, it's still more advantageous to sell premium than it is to buy premium. And since covered calls consist of buying the stock and then selling calls against your long shares, you definitely want to sell those calls when they're at advantageous premium levels. In this case, we've determined the premium levels are advantageous for selling, so we can check that off our list. Next thing we want to do is just make sure that there's a good buying opportunity in Disney, of course. So the first thing I see in Disney, when I'm looking at just the price chart, is we've really kind of found some support around this level, it appears. Prior to finding some support to that level, there was certainly some downtrending that took place in the stock. And is that downtrending over? Can't be certain. One thing that I am certain about is we haven't really seen any lower lows. Here's some lower lows that we saw. That was kind of the last lower low we saw. Since then, it's just been continuing to stay at this support level. So I think it's found some pretty good support right in the 90 area. Kind of around this 90 area. No precise level of support, just the 90 area, somewhere between 90 and 92. There's some good buy-side support. And I think that's going to push it above this, downtrend resistance line at some point in the future. Do want to make note that there is earnings coming up in 8 days. So earnings could be what catapults it higher. Or earnings could catapult it lower. Or it could do nothing. That's the risk you have to take, you have to factor in when earnings are around the corner. So, when earnings are around the corner, it's always good to kind of size down your position a little bit if you're entering pre-earnings, or just kind of hang out, wait and see how it reacts to earnings, and then revisit at that point. But in this case, we're going to continue to analyze. So another interesting thing I see here is if I pull up my channel tool and smooth out, we're in the social sentiment area now. We're looking at sentiment now. So you can see the sentiment itself was definitely downtrending for quite a bit. But recently, that downtrend has fell off and we've stabilized in the sentiment realm of things. Now, if you match that up with price, you can see the sentiment started downtrending back here. It was forward looking, so we didn't actually see that come to fruition until a couple months later. The downtrend started, and now we started to flatten out around here. About a month later, it started to flatten out. It hasn't started, so basically we're seeing a correlation between sentiment and price here. We haven't seen any bullish indications in sentiment yet, but the fact that it's stabilized tells me that we're probably not far from seeing some bullish indications in sentiment. So positioning now could be advantageous. If we take a closer look at the mentions, I haven't seen much increase in positive mentions per se. So the positive mentions are the green area. That's been pretty flat. Yeah, pretty flat there in positive mentions. But we are seeing some uptrending in just mentions in general. So the blue area is neutral mentions. But mentions are good, I mean, as long as they're not negative, they're good. And some argue that even negative mentions are good. As long as they're talking about you at an increasing rate, that's a positive thing. So the fact that we're seeing the neutral mentions and just overall mentions slowly uptrend says more and more people are talking about Disney and the brands associated with it. So, that's a good thing. I think the fact that we have an increase in mentions, not negative, just neutral mentions, flat sentiment after some downtrending, is a positive sign that the stock, at the very least, will remain sideways, but may start to see some upside momentum here. So how do we do a covered call? It's very simple. You go to the trade tab, and you can go here to single spread. You can change that to covered stock rather. But before we do that, let's just kind of get an idea of exactly how you build this spread. First, you would just be buying shares of the stock. So here we have 100 shares defaulted. So for every 100 shares, generally, you buy one contract of the option. Now, which option do you buy? Well, I tend to stay fairly close to the money. So currently the price of Disney is $92.20. Our closest strike would be $92.50. That's probably a little too close. But, going 2.5 strikes up, or not 2.5 strikes, but 2.5 points up to the 95s keeps us pretty close to the stock, but still gives us a pretty decent premium number here. We look at the bid side, we'd be selling it for $1.30. So we'd sell these 95 calls for $1.30. So essentially we'd be buying 100 shares of stock, and we'd be selling simultaneously the 95 calls. So if I hold the control key and I click the bid here, it's going to give me an error. It's going to say you can't create a custom covered spread. So that's why you have to go over here to this spread area, change it from single to covered stock. I just kind of wanted to show you the mechanics of it first. So technically what we're doing here, buying the stock at $92.20, selling the 95 calls for $1.30. So essentially we're going to reduce the price, the cost basis, by $1.30. So our cost basis is going to be $1.30 less than the $92.20 price here. So what would that be, like $90.90, something like that? So we got to go to covered stock, and we're going to go down here to the 95s, and yeah, there we are, $90.90. So if we click buy, if we click the ask, what it's going to do is it's basically going to build exactly what we were trying to build just a moment ago. Let's change this to 1. So we're buying 100 shares of Disney and simultaneously selling one contract of the 95 call. That gives us a 90, basically 90-90 debit. So it reduces our cost basis. Instead of just outright buying shares for $92.20, we're reducing our overall capital exposure to $90.90. Now if we right click and analyze the trade, it'll take us over here. You can see this is essentially a synthetic call. So basically we're buying the shares of the stock and selling a call against it. It's known as a synthetic call because it's basically the same thing as just buying a call, but you get to own shares. So the advantage of this, so here's what your objective is. Your objective is to go back here. Let's look at this single again. Your objective is to buy the shares at 92.20, sell these calls at the 95 calls at $1.30. You want, in a perfect world, you want the stock to stay below the 95 price point during your holding period. And that way, so if it stays below the 95 price point, that way you collect all the premium that you obtained from selling those calls. And then what you do is you just go to the next month or 2 months from that point, and you just sell calls again. And you just keep doing it over and over and over and reducing the cost basis of the stock until eventually the stock reaches the call strike and you get called away from your shares. So cost basis, it's a cost basis reduction tool. It's great for a stock like Disney that doesn't move a whole lot but has some decent premium built into the options right now, because you have a pretty good chance of those calls that you're selling decaying in value pretty quickly and reducing your cost basis, and you can realize those gains and move on to the next month in an effort to continue to reduce your cost basis. Now, if the stock does happen to just go up to 100 basically, then essentially you are forced out of the position. You're forced to take profits at $95. So your profit would be the difference between $92.20 and $95. So you'd be looking at a $2.80 profit. So you're forced to take profits. That's what I call champagne problems. That's a beautiful thing. The worst case scenario is that Disney just absolutely tanks. You would make all the money on the calls, but you would lose on the share price, on the shares that you own. So in that case, you would just sell calls at a lower strike that's closer to whatever price. So let's just say it tanked down to $85. Then you might sell some 87.5 calls against it if it tanks down to there. Then you're kind of booking losses. You're kind of guaranteeing losses at some point there. It's an interesting game, and I love playing it with stocks like Disney that don't move around a lot. Another thing I like to do, it can be a more capital intensive strategy. So something like Twitter could be a good candidate for it, where you could buy shares of Twitter at $17.70, and then you could sell some. Let's see, like some 19 calls for 86 cents. That's a much cheaper, less capital intensive doing it because it's a cheaper stock. I don't know if Twitter really has the social sentiment to back up doing that, but just kind of wanted to give you an idea of a less capital intensive way of doing this particular strategy if capital is an issue for you. But Disney, I think, presents a pretty good opportunity here from an implied volatility perspective, has some good price support intact in the price area, has earnings coming up, so you do want to watch out for that. You do want to make sure you size accordingly or just avoid. But the fact that it's downtrended, it started downtrending prior to the actual price downtrend. It started stabilizing in sentiment prior to the stabilization in price, and now we're starting to see some nice uptrending in overall mentions. I think there's a moderate bullish case here, at least enough of a case to strongly consider this covered call strategy. It's a perfect stock for this strategy, so I think I just might go ahead and do it. Hope you learned some stuff in this video. Signing out. Special pro tip alert. Visit learn.likefolio.com. We've got more Likefolio Trade School videos, all exciting, jam-packed with education, beneficial, actionable, awesome. Also going to have a special brokerage offer for you, so make sure you visit.